In 2011, Hewlett-Packard paid $11.7 billion for a British software company, the biggest tech acquisition in European history. The CEO called it a jewel. The press called it a masterstroke. 13 months later, HP wrote off $8.8 billion of it, the largest write-down in tech history at that point. And the man who sold them that jewel, he died on a super yacht off Sicily weeks after an American jury found him not guilty. This is the story of Mike Lynch and Autonomy Corporation. Cambridge, England, 1996. A mathematics PhD student named Mike Lynch had an idea most people couldn't fully understand. That was kind of the point. Lynch had spent years studying probability theory, the kind of math that finds patterns inside chaos, and he realized that same logic could solve the biggest problem in modern business: too much information that computers couldn't read. Emails, voice recordings, legal documents, video files. Companies were drowning in data that didn't fit neatly into any spreadsheet. Regular software was blind to it. Lynch built something that wasn't. He called it IDOL, the Intelligent Data Operating Layer. It processed unstructured data the way a human brain does, by reading probability and context, not just keywords. It was genuinely something new, not a marketing claim. A real technical breakthrough. Autonomy went public on the London Stock Exchange, then started acquiring competitors. Over a decade, Lynch made more than 30 acquisitions. The British press went wild. Here was a homegrown genius taking on Silicon Valley. He sat on government advisory boards. He was worth £500 million. They called him the Bill Gates of Britain. By 2011, Autonomy was the second largest software company in the United Kingdom. Revenue was growing. Margins were extraordinary, far above what most comparable software companies in the world reported. And that was always presented as proof that technology was just that good. Then Hewlett-Packard came calling. HP was in trouble. The personal computer business was dying. The company needed to reinvent itself as a software and services giant, fast. Autonomy looked like the perfect vehicle. Pure software, high margins, recurring revenue. HP's chief executive announced the deal at a 64% premium over Autonomy's market price, $11.7 billion. He called it transformative. Nobody asked enough questions. Not then. Here is the thing about Autonomy's revenue numbers. They look spectacular because of what was hidden inside them. A software company and a hardware company are worth completely different amounts of money. Software margins are high, revenue is recurring, and investors pay a premium for that. Hardware margins are thin, revenue is unpredictable, and investors pay far less. Autonomy was telling the world it was a software company. But according to HP's forensic investigation confirmed later by a United Kingdom civil court, a significant portion of what Autonomy was booking as software revenue was actually something else entirely. Here is how it allegedly worked. Autonomy would buy hardware, servers, and third-party equipment at cost, then sell that hardware to customers at a loss, below what it paid, and book that transaction as a software license deal, not a hardware sale. The loss got buried, the revenue appeared as high-margin software business. It was an accounting costume. Hardware dressed up as software so the whole company looked more valuable than it was. HP's investigation concluded that up to 15% of Autonomy's total revenue may have been this kind of misrepresented sale. 15% doesn't sound enormous. But when your entire $11 billion valuation rests on the story that you are a pure-play software giant with industry-leading margins, 15% in the wrong category destroys the whole story. There was a second technique, too. Transactions were run through resellers who would buy Autonomy products and technically sell them on to end customers. But some of those deals allegedly had no real end customer waiting. The reseller bought the product, Autonomy booked the revenue, and the reseller was quietly compensated later. Pull future revenue into the present. Make growth look faster than it is. Make the company look bigger than it is. The psychology here matters. This wasn't desperation. Autonomy was genuinely successful. The technology was real. Lynch was genuinely brilliant. But there is a specific kind of hubris that infects brilliant people. The belief that because the product is real, the financial story told to the market doesn't need to be perfectly honest. That belief is always, eventually, catastrophic. Someone inside Autonomy saw exactly what was happening. A senior finance executive grew uncomfortable enough with the accounting practices to contact Hewlett-Packard directly after the acquisition closed. That whistleblower handed HP the thread, and when HP's forensic team pulled it, everything came apart. But the signals were already there before that. Autonomy's margins were consistently and significantly higher than any comparable software company in its sector. When a company outperforms its entire industry year after year, there are only two explanations. Either they discovered something genuinely revolutionary, or the numbers are not what they appear. For years, investors, analysts, and ultimately HP's own board accepted the first explanation without verifying what the revenues were actually made of. HP's due diligence process should have caught the revenue misclassification. But the deal moved under competitive pressure and a compressed timeline, and urgent deals with enormous premiums are exactly the conditions where critical questions get swallowed. The auditors signed off. The lawyers signed off. The board signed off. $11.7 billion changed hands. October 2011. The deal closes. HP's chief executive is fired weeks later, before the ink is dry. By 2012, Autonomy's revenue growth is nothing like what was projected. HP's teams cannot reconcile the financial models they were sold with the business they actually acquired. Then the whistleblower makes contact. November 2012, HP announces an $8.8 billion write-down, more than $5 billion attributed directly to accounting irregularities at Autonomy. HP's stock collapses. Shareholders sue. The Securities and Exchange Commission and the United Kingdom's Serious Fraud Office both open investigations. Lynch fought back. He called HP's accusations a cover story for their own incompetence. He argued that any buyer who pays a 64% premium and then watches the business decline will always look for someone else to blame. There was real truth in that. HP's due diligence failures were documented, but in 2022, a UK bi-court judge ruled, after 9 months of testimony, that Lynch had committed a prolonged and intentional fraud. Then, in 2024, a United States jury acquitted him on all 15 criminal counts. Same facts, two countries, two different verdicts. 6 weeks after that acquittal, Lynch boarded his super yacht off Sicily to celebrate. A storm hit overnight. The yacht sank in minutes. He was gone. In March 2026, a court ordered his estate to pay £920 million to HP. The legal battle outlived the man at the center of it. So what does this case actually teach you? First, revenue numbers lie when you don't ask what's inside them. Total revenue looked clean at Autonomy. But the composition, software versus hardware, recurring versus one-time real demand versus manufactured transactions, told a completely different story. When you evaluate any company, break down revenue by segment. One honest question about revenue mix would have exposed the entire gap. Second, a large premium demands even more scrutiny, not less. HP paid 64% above market value under a compressed timeline. That is exactly backwards. The bigger the check, the more time you need. Urgency and competitive pressure are tools used to prevent clear thinking. Third, outlier margins are a question, not a reason to pay more. If one company's profitability is dramatically better than every competitor in its industry, demand a specific and verifiable explanation. Exceptional performance without a clear structural reason is a warning sign dressed up as an opportunity. And fourth, the whistleblower is always there. Someone inside usually knows. The question is whether the institution is willing to listen before the money moves, not after. The next fraud you encounter will not look like fraud. It will look like an opportunity. It will have great margins, a visionary founder, and a story that makes you feel like you would be stupid to miss it. That feeling is the trap. Every week, another billion-dollar story unravels. Subscribe to Capital Sin so you catch the warning signs before the crash. And if you spotted the red flags in this one, drop a like. That means you are already thinking like an investigator.